How you doing? I'm Big D. Welcome to the show. We're getting very close to Christmas and the holidays, so be safe out there. What we're going to talk about today is Samsung. What is going on in the battery world because silver is going to be affected by a huge number. We're in a deficit already. We're going to be deep very soon. Now, they want you to look at the ticker and panic because the price of silver dropped to $61.84 last Friday. They want you to believe that the rally is over, that the squeeze has failed, and that the banks have won yet another round of their paper game. Silver paper is not the way to go. Physical silver is the only way to own silver. But this is a lie, an omission, so massive it borders on criminal negligence. While you are staring at the red candles in the charts, watching silver, the laws of physics were quietly rewriting the future of the global economy in a laboratory in South Korea. And we're going to expose the technical reality that makes paper irrelevant, proving why this week is likely the last time you will see silver this cheap again. Possibly they're going to find a way to suppress it, but the move should happen this week. You have to understand that what we are witnessing is a divergence between two realities: the financial reality and Wall Street, and the physical reality of energy transition, which happened on Friday. Algorithms that run the commodities futures market saw a CPI print they didn't like and dumped the paper. Contracts smashing the spot price. It was a knee-jerk reaction, a digital hallucination. But simultaneously, Samsung SDI, the battery giant that powers the EVs for BMW, Stellantis, and Rivian, confirmed the final specifications of their S-line mass production. The media is calling it a battery breakthrough, highlighting the 9-minute charge time and a 900-mile range. But they are missing the single most important detail, the one that makes a $1.1 billion ounce deficit looks like a rounding error. The secret ingredient in Samsung's new solid-state battery isn't lithium. And it isn't nickel, it's silver. And not just a trace amount used for conductivity. We are talking about a fundamental shift in battery chemistry that moves silver from precious metal to a strategic energy metal. The understanding why this is an extinction level event for supply. You have to look at the problem. For 30 years, lithium-ion batteries have been limited by the formation of needle-like crystals called dendrites that grow during fast charge, piercing the separator and causing fires. If you wonder why fires happen with electric cars and laptops on airplanes and cell phones, this is why. Samsung engineers solved this by using a silver carbon A nano composite layer. Because silver is lithophilic, meaning it chemically loves the lithium. It dissolves the lithium ions instantly as they arrive at the anode, spreading them out evenly like butter on toast. This prevents the dendrites to stop the fires and enable the super fast charging the world has never seen before. But here's the catch that bankers missed. To make this physics work, You cannot thrift the silver out. You need bulk, mass amounts of silver. You need grams, not micrograms. Let's run the numbers that Wall Street is terrified to be published. The specific mathematics of extinction that turns a simple supply deficit into a market vacuum. Right now, if you strip down a standard electric vehicle, a Tesla Model 3 or a Chevy Volt, you will find about 30 to 50 grams of silver. It is used in the membrane switches, the battery management system, and the solar glass on the roof. That usage alone has already pushed the market into a structural deficit. But Samsung solid-state batteries changed the equation from arithmetic to exponential calculus. We are already talking about silver at a trace element for conductivity anymore. We are talking about it as a structural component of the anode itself, technical analysis. Of the AGC nanocomposite layer suggests that a silver loading of approximately 5 grams per battery cell. Now, a standard 100 kilowatt battery pack, the kind needed to achieve that 900-mile range, contains roughly 200 of these cells. Do the simple multiplication. 5 grams, 200 cells equals 1,000 grams. That's a kilogram of silver. In the language of investing in precious minerals, that is 32.15 troy ounces sitting in the chassis of a single luxury sedan. To put that into perspective, that is a full tube of Silver Eagles plus another half tube melted down and sealed into every single car that rolls off the assembly line. Now apply that to a global fleet. There are roughly 8 million cars produced on this planet every year. Let's be conservative, extremely conservative, and assume that the 2028 model year, only 20% of the new vehicles utilized this top tier solid state technology that is 16 million cars. If you multiply 16 million cars by 1 kilogram of silver each, you have 16,000 metric tons of new annual demand. The entire global mine supply is only 26,000 tons. Now, this specific use case, this single silver investment strategy by the auto giants, threatens to consume over 60% of the silver mined on Earth. That leaves zero silver for solar panel industry, which already eats 15% of the supply. It leaves zero silver for the electronics in the cell phones, laptops, tablets, etc. It leaves zero silver for medical devices, water purification, or jewelry. And critically, it leaves zero silver for you. We are looking at a scenario where the industry demands alone exceed the total annual mine supply, creating a mathematical impossibility that the current price of $61.84, actually it's about $2 higher right now, if not $3, as of me talking to you about what is going on and what is going to happen with silver. It cannot be stopped. Silver is going to increase exponentially. The only valuable that can change in this price, it has to change violently to rotate, to ration what little metal is left. Now, the skeptics will tell you that the market will fix itself. They will quote the old adage that the cure for high prices is high prices. No. You got to have supply. This is my opinion. Who knows what's true? And again, I'm not telling you anything about going out and buying as much silver as possible. I'm not a financial guy, So don't take my word for it. Just take what I give you and do your own research to further that before you do go out and buy a ton of silver, which if I have the cash, that's what I'm doing. Now, they will argue that if silver hits $100 an ounce, the miners will simply dig faster. Sounds like a Joe Biden quote. Now, food, they will flood the market with new metal and push the price back down. This is the geological wall. Now, remember, if it was supply and demand, the supply is very little and the demand should be pushing silver up. So this scenario is not going to work. Now, this is a geological wall, and it is where the paper market theory collides head on with the physical reality. You cannot print a silver mine. You cannot quantitative ease a vein of ore into existence. In the digital world of Wall Street, liquidity is instant. In the physical world of mining, time is the enemy. It takes on an average 10 to 15 years to take a new silver deposit from discovery to first pour. If a geologist found the mother lode in Nevada this morning, that silver wouldn't reach the battery factory until 2024. What? Sorry, 2034. My penmanship isn't the greatest. I apologize. But silver that's needed by Samsung needs that metal now. The S line is ramping up today. The demand is immediate, but the supply response is frozen in a decade, at least a decade. Long regulatory deep freeze, and it gets worse. We aren't just facing a time lag. We are facing the exhaustion of Earth's crust in 2005. A high-grade primary silver mine would yield about 15 ounces of silver for every ton of rock crushed. Today, that number has collapsed to just 4 ounces per ton. We are literally running out of the easy metal. Easy metal is gone. To get the same amount of silver, we now have to dig up 4 times as much rock, burn 4 times as much diesel, and use 4 times as much water. That is the law of diminishing returns. And it means the cost of production is skyrocketing, just as the ore grades are collapsing. So that's another reason why silver prices should be through the roof, because the cost of digging that is just above whatever they find. Luckily, it is a byproduct. Silver is a byproduct of lead, copper, gold, precious metals. It's just mind-blowing that this is being suppressed the way it has over these quite a few years. We can go back 50 years, how long silver's been suppressed. Mexico produces nearly 25% of the world's silver, but the government there has effectively ceased issuing new open pit mining permits. Peru, the second largest producer, is paralyzed by the constant labor strikes and community blockades. Russia, a major source, is sanctioned. So precisely at the moment when the silver carbon revolution is demanding a 100 million ounce injection of new supply, the global mining machine is sputtering. This is a classic movement. Exploding structural demand from the auto sector colliding with a rigged system. Shrinking and politically strangled supply chains. The inventory buffer that used to absorb those shocks is gone. Now the vaults are empty. The only thing left to give is the price. This supply crunch brings us directly to the flashing red signals that appeared on the terminal screens this past weekend. The signal that usually precedes a violent re-rating of the entire complex. We are witnessing a historical decoupling between the paper price in the West and physical price in the East. If you look at the COMEX ticker in New York State, the algo driven price is sitting at the deprived, very low, $62, $63 range. But if you look across the Pacific, the Shanghai Gold Exchange, the SGE, the physical heartbeat of the Asian market, you see a completely different reality. In Shanghai, silver is changing hands at a premium equivalent to $67 to $68 per ounce. That is a massive persistent arbitrage gap of over $5. In a functioning, efficient market, a gap of 10 cents is considered huge. A gap of $5 is a broken market. It screams that the metal is in the wrong place. The bankers in New York are trading papers contracts based on inflation data. And Fed whispers, but the traders are in Shanghai and they are standing at the gates of the Shanghai and TATL factories. They see the procurement officers panic buying. They see the 1,000 gram loading requirements and purchase orders. They are pricing in the silver carbon revolution while New York is still pricing in the recession. This creates a mechanical unknown as a arbitrage. Smart money, the global macro funds, and the industrial trading houses sees this disparity. They realize that they can buy cheap silver contracts in New York of the low 60s and take physical delivery and ship it to Shanghai and sell it instantly for $68 an ounce. It is a risk-free profit trade, but here's the consequences to capture that profit. They have to drain the physical market out of the COMEX vaults. They are stripping the West of its strategic inventory to feed the battery furnaces of the East. This arbitrage is the reason the price drop on Friday is destined to fail. The lower the paper price goes in New York, the wider the gap becomes. The faster the metal flows out of the vault. It is a self-correcting mechanism that functions like a vacuum cleaner, sucking every available ounce out of the London and New York and depositing it into the strategic reserves of China and South Korea. When you see a divergence this extreme, it is not a sign of weakness. It is a sign of the vault run. The paper price is lagging. It's an indicator. The Shanghai premium is the leading indicator. The East has realized that silver price prediction models based on legacy demand are worthless. They are buying the future, and right now the West is practically giving it away. However, if you are rushing to see your brokerage account to blindly buy any stock with the world silver in its name, stop immediately. You are walking into a trap that has destroyed more wealth in this sector than any price crash. It has become a mania. Not all boats will rise to the tide. In fact, some of these are anchored to the ocean floor by a financial institution known as the hedge book. This is the single most critical data that separates the life-changing 100x gains from the dead money. That goes nowhere. While the metal screams higher, here is a nightmare scenario. You correctly predict that Samsung just broke the silver market thesis. You can watch silver spot price climb from $62 to $100, and I believe that wholeheartedly that that is exactly what's going to happen. But don't take my word for it, please. Do your research. You'll see exactly what I found. At least I believe. Leave a comment in the comment section. Let me know what you believe. Now, you hold shares in massive mining, expecting that they are going to skyrocket, but they don't move. Why? Because 3 years ago, when silver was languishing at $22, the company managed team was scared. They secured a loan, pleased a risk officer. They signed a forward sales contract, a hedge locking in the sale price of their future products at $28 an ounce for the next 5 years. Now, silver is at $100, but the company is contractually obligated to sell its metal to a bullion dealer or a bullion bank. And then the bank takes the physical silver, sells it at a market price of $100, and pockets the $72 difference. The bank gets rich, and your thesis, the mining company, just breaks even. The inflation of the metal price bypassing the shareholders completely. They offer what we can operating leverage. Let's say a miner has a production cost of $20 per ounce. At $30 silver, they make a $10 profit. If the silver goes 100, a 3 times increase, their margin doesn't triple. Doesn't just triple. It goes from $10 to $80. That is 8 times explosion in the profitability on a 3 times move in the metal. This is the math that creates dynasty wealth. But you only get the leverage if the miner is unhedged. Before you buy a single share, you need to open the company's quarterly profits reports. Hedging or derivatives and ensuring the number is zero. If they are selling forward, they are betting against the very shortage you are betting on. I do appreciate you stopping in. What we are looking at, it's going to be a catastrophic for a lot of different reasons. Your phone that you have in your pocket was $1,200-$1,300. Could that go to $4,000? Who knows? It sounds like it could. Could a laptop that was $300-$400 now be worth $1,200-$1,500? Never mind an electric car. I mean, that's a lot of silver. Leave a comment in the comment section. I would really like to know what you think or where you believe silver is going to rise to, because I don't think it's going to drop. If it does drop, it's not going to do much more than what it already did last Friday. That's my opinion.